Gold & Co. Financial offers premium insurance products to help you maximize the efficiency of your holding company while minimizing the risks. Our customized services are designed to provide you with the ultimate financial strategy and peace of mind, tailored to your unique needs. This is how we do it. So this is the income of the company and expense. One of the expenses is salary. The difference between the two are pure of it. This profit is now taxable as active income. The tax on active income for a company is 27%. But if you qualify as a CCPC, the first $500,000 of the SBL is taxed at 11%. So for you, about an average tax rate of 24%. After tax, this income becomes retained earnings or profit non-distributed. It's money taxed in the corporation, but not taxed in your hands as a person yet. The corp is a taxpayer and gets taxed at a different level than you. This money is trapped there, and it is normally invested so it can accumulate. So now it is called passive income on the money you make. Because it is not that company that earns it, but the investment itself. It can be in funds, it can be in real estate, or anything you choose. Passive income is taxed much higher, at a flat rate of 50.7%. So in fact, the true tax of the company is a blended rate of the active and passive income. So let's say you have $1 million and it's invested with a return of 5%. That's a $50,000 return with a $25,000 tax bill, even if you don't earn anything as a company through active income. In 2017, the government added another rule. If the passive income exceeds $50,000 per year, it will impact the SBD and start clawing back the 16% SBD bonus. Once your passive income reaches $150,000 per year, you will have no SBD at all. So passive income will eventually impact your active income as well. This is why we hold an asset class named participating life insurance instead, because the dividends paid in these are completely tax-free and will not affect your passive income amounts. It is sheltered from tax and has a return of about 5%. The active income is called the operational company, when the company doesn't do anything and just invests or holds shares of other company. This is called the holdco. This solution is to maximize the efficiency of the holding company. The OpCo and holdco are related, as the OpCo can pay dividends to the holdco, and when the OpCo needs money, you can push the money down through a loan through the company. No tax. So what we do is detain the insurance contract through the holdco. How we pay premium is OpCo pays dividend to holdco and holdco pays premium. Holdco owns the policy and is the beneficiary as well. The tax issue here, we have 27% on active and 50.7% on passive. And one thing we haven't discussed, the owner has to pay themselves a salary or dividend. Almost the same thing, but dividends are actually worse, as you have to pay tax on the active income, as well as the dividend. A double tax of, let's say, 11% plus 48% dividend tax, so 59%. Salary is only taxed once, just 53%. Why is insurance important here? It's important to bypass this 50.7% tax. So if we transfer the money from profit, not into an investment, but into the premium of the insurance contract, this insurance is an asset class itself. So we designed this policy to not only protect, but to have returns, and the return is about 5%, depending on age and cost of insurance. But at the end of the day, the dividend scale is at about 6.2%. After cost of insurance, you end up around 5%. But it is tax-free. So otherwise, if you did an investment at the 50.7% passive income rate, you would have to get double the returns to match the return of the insurance contract. So the insurance now becomes an asset class. It's like a GIC or certificate. So how liquid is insurance? Because the primary reason to invest is to accumulate as well as have access to it when you need it. The insurance is a cash reserve, and you can borrow against the policy as a corporation when the need for capital arises. The loan is at 6.2%, and the return is 5%, so it doesn't cost a lot to borrow. So when you need cash, you go to Equitable and get a loan and put the money back in the corporation, not the hand of the shareholder, as a cash reserve. So if the shareholder dies, the business owns the policy, they are the owner and beneficiary and payer. So when you pay the premium as a corporation, it is with cheap money, taxed at only 11 or 27%, not 53% in the hands of the shareholder. So if you buy the insurance outside the company, you can see it is more expensive. This is the first advantage. The second advantage is you kill the incurring 50.7% passive income tax. But the third and biggest advantage, when the death benefit is distributed, because the life insured passes away, It goes through the company, and it can be elected to go through the CDA or capital dividend account tax-free. So the death benefit is tax-free in the heir's hands. So you save tax not just once, but twice. So the dividend and cap gain of the policy is not taxable like other regular investments. So let's say the holdco holds real estate. The rental income is taxable at 50.7%. You sell the real estate, the capital gain is taxed at 25%. Then the money is stuck in the corp, and you need to pay dividend tax of 48% to get it out, 3 times taxed. Why life insurance is magic in a corporation as an asset class? You don't have tax anywhere. It is tax preferred. Par policy kills all 3 while providing protection at the same time. That's the first step. The second step is when people invest and accumulate in their corporation, they typically want to access it at retirement age. So this is IRP, or in-service retirement planning. So what is IRP? When the business owner wants to retire, the money is there in cash value in the insurance, so the corporation will borrow from the bank and collateralize the assets and pass to the shareholder. When we do that, we have a dividend or pension plan. The second way is a shareholder loan. So the corp doesn't take a loan from the bank, but the shareholder, and they collateralize the asset in the same way. This way, the money comes from the bank and not the corporation. There is no dividend. The bank is satisfied, and they do it like a reverse mortgage on the assets. The bank doesn't care if the assets is in the corporation or your hands. And when you die, the bank has access to the cash either way because the death benefit is paid to the corporation. When you do it that way, you just bypass the 38% dividend tax. But now the CRA is not happy. They didn't get a chance to tax you on it. So you need to make peace with the CRA. When you take a loan from the bank, it costs about 6%. But if you collateralize it with a guaranteed asset, they will charge 4%. The difference between the two is 2%. What you can do is put that 2% back into the company. Now the company has a taxable income in regards to the CRA. You make peace with CRA, and it is very cheap to do so. You pay 2% and not 38%. The next step is to set up a policy with a 10-year offset. You pay for it for 10 years and it is done. You can do this through cash flow or the attrition of retained earnings or investment. So let's say there is $1 million in retained earnings. We can set up a policy with a premium of $100,000 a year for 10 years and transfer it into a tax-preferred accumulating asset. So the $1 million is moved out after 10 years. You can see the liquidity, even after 1 year, is around 80% in cash. You can access this the very first year. After 4 to 5 years, you can get 100% of your money back and still have a massive insurance amount. Even if you use this cash by policy loan and pay interest only, it is still paying and accumulating dividend. It is like buying a piece of real estate by mortgage and still keeping the appreciation. At age 65, we can do IRP and use the cash flow to pay a retirement income for 20 years, completely tax-free through shareholder borrowing.